Welcome back to the deep dive. We are jumping straight into, well, a really confusing financial situation today. It's got a lot of smart investors scratching their heads.
It really does.
We're dissecting the fascinating case of Remitly Global, ticker RELY.
RELY. And it's almost the definition of cognitive dissonance in the market right now.
How so?
Well, if you just look at the fundamental results, the numbers they reported for Q3 2025, they were phenomenal.
Right. Beat analyst expectations.
Beat them handily. And they even raised their full-year guidance significantly. Everything looked great on paper.
Yet the stock, it absolutely plunged.
Didn't it just? We're talking roughly 25% down overnight.
Hitting multi-year lows, too. It's just wild.
It is. And that's the massive disconnect we really have to unpack for you today. Why on earth did the market punish a company that, by pretty much all metrics, delivered a stellar quarter?
So that's our mission here. We need to try and cut through some of the FUD, right? The fear, uncertainty, and doubt that seems to have driven that sell-off.
Exactly. We need to move past the market's maybe obsession with these secondary narratives. You hear things about stablecoin disruption or maybe temporary immigration fears.
Things that aren't the core business itself.
Precisely. We need to analyze the true engine of Remitly. What is its fundamental business model? What's its competitive advantage? Its moat.
And the big one.
And the really big one, yeah. The fact that it has just hit, arguably, the most crucial milestone in its entire history.
Which is?
GAAP profitability. Actually making money on a generally accepted accounting principles basis.
Okay, so before we dive deep into that, let's do a quick refresher. For anyone maybe less familiar with this space, what exactly is Remitly?
Right, good idea. So in its purest form, Remitly is a 100% digital remittance provider.
So think online money transfers.
Totally online. Forget the physical agents, the money transfer kiosks you see around. This is entirely app-based. It's like the online version of a Western Union, basically.
Built specifically for cross-border stuff.
Specifically for cross-border transactions, yes. And crucially, its core focus, its bread and butter, is the flow of money from highly developed nations, think US, UK, Canada.
Places where immigrants often work.
Exactly. And sending money back to developing nations. And often, these are frequent, relatively small amounts.
Money that gets used right away.
Gets used almost immediately for essentials. We're talking food, rent, utility payments, lifeblood money, really.
Okay, that focus on the immigrant community and these essential payments, that feels key.
It absolutely is.
And this brings us right back to that central conflict, the puzzle we need to solve. We got a company that's clearly eating market share from the old guard. It's demonstrating massive operating leverage, getting more efficient as it grows.
Yeah.
And as you said, it's officially achieved GAAP profitability. That's a monumental inflection point.
It should be.
So why is the broader market treating it like it's, I don't know, some dying, obsolete player?
It truly seems to boil down to the market having this maybe myopic focus on one specific item.
Which was?
The preliminary 2026 outlook. Management gave some initial thoughts, suggesting revenue growth might slow down a bit.
To what level?
To the high teens in 2026. Now, it's down from the robust 28% growth they're forecasting for the full year 2025.
So, still growing fast, but decelerating.
Exactly. And that expectation of deceleration, even with potentially massive margin expansion coming down the pike, well, it just gave the bears and the short sellers all the ammunition they needed.
Triggered a brutal sell-off. Driven by narrative, not necessarily the full picture.
That's how it looks, a narrative-driven sell-off.
But as you're suggesting, the fundamentals, the underlying business, tells a far more resilient story. Maybe even an exciting one.
I think so, yeah.
So let's dive into those fundamentals. Let's start right at the beginning. How did this company even get started? What specific pain point were they trying to solve?
Right. The founding story is really essential here because it defines the company's entire value proposition, why they even exist. So back around 2010, one of the co-founders, Matt Oppenheimer, he was working in Nairobi, Kenya.
Okay.
And he saw firsthand the struggle people went through just to receive these vital payments from family abroad.
What kind of struggle?
Huge queues, people waiting in line for hours, paying exorbitant fees, sometimes 5%, even 8% or more, just to get a relatively small transfer.
Wow, 8% is a lot.
It's massive. And even after all that, there was still this profound uncertainty about whether the money would actually arrive that day.
So stressful.
Hugely stressful. And remember, these weren't like bonus funds. These were lifelines, money for basic needs.
So Remitly saw that whole Inefficient, expensive, stressful process.
And decided the solution had to be total digitization and, crucially, vertical integration, building the whole system themselves.
Okay, so how does that digital value proposition, how does it radically contrast with the old way? The traditional model, dominated by banks and the big wire services.
Well, the structural advantage, it just jumps out at you immediately when you look at their cost structure.
Also,
Traditional providers, they rely on expensive physical branches, right? Agent commissions, lots of manual processes.
overhead. Lots of overhead.
Tons of it. Remitly operates with 0 physical branches. None.
Okay.
Which means its underlying costs are just substantially lower, period. And they use that efficiency to compete really aggressively on price and also on transparency.
And when we actually look at the numbers, the cost difference, that competition is real, isn't it?
Oh, absolutely. You look at their weighted average take rate, that's basically the percentage of the transfer amount they keep as revenue.
Right.
In Q3 2025, it was just 2.15%.
2.15% compared to the 8% you mentioned earlier.
Exactly. Dramatically lower than the 5%, or often much more charged by the legacy providers for essentially the same service. They're leveraging their scale, their automation, to really compress industry margins.
Forcing the shift to digital.
They are. It makes the digital option just much more compelling financially.
And I found that specific transfer example you shared really fascinating, especially when you look at slightly higher amounts where their efficiency really shines.
Yeah, that's a great illustration.
Yeah.
So imagine a customer sending, say, a reasonably sizable amount, like $1,000, to a bank account in Indonesia.
Okay.
Remitly offered that service with just a flat fee of $1.99.
Just under $2 to send 1,000.
Right. But maybe even more impressive is the transparency around the currency conversion, the exchange rate arbitrage, the spread they keep on the FX.
Yeah.
It was only about 0.5%, 0.5%.
That's tiny.
It's incredibly low. So when you add up the total cost to the sender, the fee plus the FX spread, it's almost negligible compared to the traditional alternatives. It just shows incredible efficiency at scale.
And beyond just the cost savings, which are obviously huge, the elimination of that uncertainty, the waiting, the delay, that must feel like a complete revolution for the customer base.
Oh, it's a total game changer. Absolutely. They've really optimized for speed and reliability.
How fast are we talking?
Over 94% of their transactions are completed in under an hour.
94%.
Under an
An
hour.
hour. Yeah. And the platform's reliability, the tech itself, is essentially flawless. They report 99.99% app uptime.
Almost perfect.
Basically perfect. So just think about the emotional relief for both the sender and the receiver. They've effectively eliminated that core anxiety, that waiting game that defined traditional remittances for decades.
And that builds trust.
That builds incredible trust, and that trust drives loyalty, repeat business.
And because their focus is often on developing nations, they can't just offer, say, direct bank deposit as the only way to receive money, right? They have to deal with whatever local infrastructure exists.
Precisely. That's a crucial point. Their multimodal payout network, the different ways people can get the money, is a massive value driver. And frankly, it's a huge competitive barrier.
What kind of options are we talking about?
While cash pickup is still vital in many places, they have over 490,000 cash pickup locations globally.
Wow, almost 500,000. Yeah. Then there's direct deposits, obviously, into potentially 5.4 billion bank accounts worldwide. Mobile wallets, which are huge in many regions.
Like M-Pesa or similar.
Exactly. And even in select markets, last-mile home delivery options.
The real flexibility.
Total flexibility. It means they're truly agnostic to the recipient's specific technological setup or banking status. And that's absolutely vital for penetrating deeper into huge markets like India, the Philippines, Mexico, Nigeria.
Makes sense. That seamless functionality, the reliability of the network, it brings us directly to their competitive moats.
Yeah.
Because building this kind of reliable cross-border system, it just sounds like a regulatory and logistical nightmare.
Oh, it is. It's a phenomenal feat of both engineering and regulatory compliance, which is exactly why the company has spent 14 years painstakingly building this vertically integrated platform.
14 years.
Yeah, and their competitive advantages, they're rightly classified by analysts as intangible assets, things you can't easily touch, but which create this wide moat, a barrier that's almost impossible for someone new to replicate quickly.
Okay, so what are the specific components? What makes this network so defensible? Break it down for us.
Well, first and foremost, it's the sheer complexity and breadth of their global payment rails.
Okay.
We're talking about operating over 5,300 specific corridors. Think U.S. to Mexico, U.K. to India, Canada to Philippines.
Thousands of them.
Thousands, across more than 170 countries. And this isn't just, hooking up a few APIs like some newer fintechs might try.
It's deeper than that.
Much deeper. This includes navigating the incredibly dense state-by-state in the U.S. and then country-by-country web of money transmission licenses. That alone requires massive, ongoing legal and compliance investment.
Just getting the license is hard.
Incredibly hard and expensive. Then it includes direct, deep integrations with literally thousands of local banks and payment rails globally. This network isn't just difficult to build from scratch.
Yeah.
The ongoing regulatory maintenance, the compliance burden alone is prohibitively expensive for most potential new entrants.
Right. And as you mentioned earlier, trust is really the currency in these communities, isn't it?
Yeah. Absolutely critical. Brand and trust are paramount, especially within immigrant communities where loyalty is often driven by personal recommendations, word of mouth, and proven reliability over time.
And Remitly seems to score well there.
Exceptionally well. They boast an average 4.9 out of 5.0 mobile app rating across the app stores, often the highest among their direct peers.
4.9 is very good.
It's stellar. And that level of customer approval, it generates powerful organic word-of-mouth growth, which, by the way, is the most cost-effective customer acquisition channel you can have.
And their financial efficiency kind of proves this point, right? You mentioned their LTV to CAC ratio.
Exactly. Their lifetime value, LTV to customer acquisition cost, KSC, remains exceptionally strong. It's sitting at roughly 6x.
6 times.
6 times. With a payback period on acquiring a new customer that's under 12 months.
So a 6x LTV CAC ratio, just unpack that quickly. That's really good in the fintech world, isn't it?
It's truly stellar, yeah.
Yeah.
It basically means for every single dollar they spend marketing to acquire a new customer, they expect to generate $6 of net revenue, profit, essentially, over that customer's entire lifespan with them.
Wow. Okay.
That kind of efficiency gives them massive flexibility in their marketing spend and their pricing strategy. They can afford to invest in growth because the underlying economics are so healthy.
That makes sense.
And this efficiency, this whole virtuous cycle, it's only really possible because of another, maybe slightly hidden moat, one that's tied very closely to risk management.
Which is?
Fraud prevention.
Okay, explain that. How is being good at stopping fraud a competitive moat for a payment company? Seems like table stakes.
You'd think so, but it's harder than it looks, especially at scale and speed. See, if you're bad at managing fraud and risk, you're forced to do things that hurt the customer experience. You have to slow down transactions for manual reviews. You might have to block legitimate customers, or you have to increase your fees to cover the losses you're incurring.
All bad options.
All bad options. They destroy the customer experience, and ultimately they can wreck the business model. Remitly, on the other hand, leverages really sophisticated AI-driven risk models.
AI is key here.
Absolutely.
Yeah.
These models have been refined over more than a decade, trained on literally billions of transactions. They allow Remitly to proactively mitigate fraud while still maintaining that crucial speed and reliability. It's a highly effective, constantly learning control loop.
And do we have hard data on how effective they are? What are the results of that tight control?
We do. The hard data really proves their control here. In Q3 2025, their provision for transaction losses, that's essentially the money set aside to cover expected fraud losses. It was a tiny 12.8 basis points.
Basis points, so hundredths of a percent.
Exactly, just 0.128% as a percentage of the total send volume.
That's incredibly low for moving billions.
It is. To maintain that level of control while moving billions of dollars instantly across all these complex regulatory environments, it's incredibly difficult. This tight risk management directly underpins their ability to offer that superior, faster, and more trustworthy product. It's not just about stopping bad guys. It's about enabling the good transactions to flow smoothly.
Okay, that foundation sounds incredibly strong. Robust network, trust, efficiency, risk management.
It really is.
So now let's pivot and tackle that wall of worry, the stuff that actually did drive the stock down despite those fundamentals.
Right, the bear case.
Let's start with the comparison that, as you said, inevitably comes up. Wise, formerly TransferWise.
Yeah, the Wise comparison.
Yeah.
The market frequently lumps Remitly in with Wise, but as some of the more bullish investors, like Mario Sabelli at Marathon Partners, have observed, this comparison often misses a really crucial distinction.
Which is?
It's about customer segmentation. Who are they actually serving? It's almost like comparing, I don't know, a high-frequency daily commuter train to a massive intercontinental freight liner
They both run on rails.
They both use rails, they both move things, but they serve entirely different needs, different cargo, different schedules.
Got it. So what is that crucial operational distinction? What separates Remitly from Wise in the eyes of an analyst looking closely?
It really boils down to the primary use case and, critically, the average send amount.
No.
Wise primarily facilitates higher value, less frequent transfers. Think, people moving larger sums of wealth internationally, maybe business-to-business payments, or individuals funding their own bank accounts overseas.
Bigger chunks of money, less often.
Exactly. Their average send amounts are multiples higher than Remitly's typical transaction. Remitly, as we discussed, is focused on essential consumption, high frequency, low send amounts, money that gets consumed really quickly for utility bills, food, rent, daily needs.
The lifeline payments?
The lifeline payments. So because Wise targets these larger, higher value transfers, they can afford to quote a lower overall take rate, headline rate.
Makes sense. Lower percentage on a bigger number.
Right. But that doesn't necessarily mean they compete effectively or even want to compete in Remitly's core, high-frequency, low-value corridors. It's a different economic model.
So Wise having a lower headline take rate isn't necessarily a direct threat to Remitly's specific market. It's more a function of their different customer base and transaction mix.
Precisely. They're largely operating in separate, competitive lanes.
They might compete at the margins, maybe for slightly larger consumer sends.
Sure, there's some overlap at the margins, but Remitly's primary market, it's really defined by that necessity, that urgency, which often prioritizes absolute reliability and having the right local payout options over squeezing out the absolute minimum cost, especially when you're only sending a couple $100s.
Got it. Okay, separate lanes mostly. Let's move to the narrative that really seemed to spook the market. And frankly, it's responsible for a lot of the short positions across the entire payment sector right now.
Yes. Stablecoins.
Stablecoins. The fear seems pretty simple on the surface, right? Why would anyone pay Remitly, say, 2% or even 1% when they can supposedly send USDC or some other stablecoin instantaneously and for, like, next to nothing?
Yeah, this is the prevailing almost religious bear narrative you hear. It basically sees Remitly, but also giants like Visa, MasterCard, Western Union, as just indiscriminately being stablecoin losers.
Disrupted by crypto.
Disrupted overnight. The core assumption is that this new, free, instant digital currency just completely replaces the need for complex, regulated, traditional money transmission.
But you're saying that assumption is flawed.
Fundamentally flawed, because it completely ignores the entire purpose of the transaction for Remitly's core customer base. Why are they sending the money in the first place?
Which brings us to what some analysts call the last mile problem.
Exactly, the last mile. The core rebuttal here is that stablecoins, like USDC, are essentially just tokenized US dollars sitting on a blockchain. They are only actually valuable to the average person receiving money in, say, Mexico City or Manila or Lagos when they are converted, when they're off-ramped into spendable local fiat currency.
Pesos, naira, rupees.
Exactly. Local currency they can actually use to pay for things that require local cash or local bank transfers, rent, food, school fees.
So the stablecoin itself isn't the end point.
It's just a vehicle. It's not useful until it becomes usable money in the local economy.
Okay, but couldn't the argument be that, eventually some big tech player, maybe Facebook or Google or even established banks, couldn't they just partner directly with crypto exchanges like Coinbase or Binance to solve that off-ramping problem efficiently?
That's a fair question.
Couldn't they potentially sidestep Remitly's whole complex regulatory and banking infrastructure that took 14 years to build? How high is that integration moat, really?
That is absolutely the right question to ask. And this is precisely where Remitly's deep vertical integration, that 14 years of work, really proves its worth. Because that off-ramping process, it's not simple.
Not just flicking a switch.
Not at all. It involves significant friction points that stablecoins by themselves do absolutely nothing to eliminate.
Like what?
Okay, first, local KYCML compliance. You need to verify the identity of the person receiving the fiat currency, comply with anti-money laundering laws in that specific country. That's complex.
Right.
Second, managing specific local currency liquidity. You need reserves of Mexican pesos, Indian rupees, Nigerian naira, available 247 in dozens of emerging markets. That's hard.
Need the actual cash on hand locally.
You do. Third, absorbing foreign exchange risk during the conversion. Currencies fluctuate. Someone has to bear that risk.
Uh-huh.
And critically, dealing with all the local bank fees and the regulatory costs involved in actually moving money from some digital wallet into a verifiable local bank account or an approved cash pickup location.
The actual last step.
The actual last, crucial, and often highly regulated step. Remitly has spent 14 years solving exactly this heavily regulated, high-friction, last-mile problem. A new tech player might partner with an exchange, sure, but they still have to navigate that complex local, political, financial, and regulatory infrastructure.
Which is Remitly's core competency.
It's their specialty. They've built the pipes, the relationships, the compliance frameworks.
So Remitly's argument then isn't that they're a victim of stablecoin tech, but maybe they could actually be an eventual beneficiary.
Yeah.
How could they leverage crypto or stablecoins themselves?
Right. They see it less as a threat and more as a potential tool. They benefit in potentially two primary ways.
Okay, first.
First, internally. For their own treasury operations, they're already operationalizing tokenized USD, like USDC, for instant internal global liquidity management.
What does that mean in practice?
It means they can settle funds between their various global accounts, 247, almost instantly, instead of waiting for traditional banking hours or wire transfers. It reduces the amount of idle float cash just sitting around waiting to settle.
It makes their own money work harder.
Exactly. It makes their underlying capital management significantly more efficient, reduces their internal costs. They're using blockchain technology as a powerful enhancer for their back-end financial plumbing.
Okay, that's the internal plumbing. What about the customer-facing side? How might the actual user benefit directly from stablecoins via Remitly?
This is where the Remitly wallet comes in. They're positioning it as a critical customer solution, especially for customers who live in or receive money in countries suffering from rapidly depreciating local currencies.
Thinking like Turkey, Argentina, Nigeria, places with high inflation.
Precisely those places. For someone there, the ability to hold a portion of their savings or the money they receive in a relatively stable digital currency, specifically USDC right now, is hugely valuable.
A safe haven, digitally.
Exactly. It positions the Remitly wallet as a stable store of savings, directly addressing a fundamental pain point that exists for millions globally. It makes their app stickier, more usable beyond just the transfer itself.
Okay, let's circle back quickly to the unit economics here, because this seems like where the stablecoin bear argument really falls apart if you look closely at Remitly's actual financials.
Yes, this is key.
We mentioned their gross take rate, the headline number, was about 2.15% in Q3. But you made a distinction earlier between the gross rate and the net take rate. Explain that again.
Right. So the gross take rate, 2.15%, that's basically what the customer pays up front, the total fee and FX margin combined.
Okay.
The net take rate, which management emphasizes as a key internal metric, is what Remitly actually keeps after accounting for what they call customer-chosen funding and payout costs.
What are those costs?
These are direct costs that Remitly incurs based on the choices the customer makes. For example, did the sender fund the transfer using a credit card, which costs Remitly more in processing fees, versus a direct bank account debit, which is cheaper?
Okay, funding choice matters.
And similarly on the payout side, did the receiver choose instant cash pickup, which might have higher partner fees for Remitly, versus a slightly slower standard bank deposit, which might be cheaper for Remitly to facilitate?
Got it. So Remitly's profit depends partly on those customer choices.
Exactly. And after subtracting those variable customer-driven costs, what is that key net metric? What's left for Remitly?
What is it?
It's only around 1% to 1.5%. That's their actual net take rate on the transaction
I think
volume.
that's 1.5%.
Yes. So now think about the stablecoin argument again. If stablecoins down the road somehow manage to reduce the wholesale funding costs, the cost for Remitly itself to acquire the foreign currency, it needs to settle the transactions.
Yeah.
Remitly could afford to drop its gross take rate, the price the customer sees, maybe even closer to zero on some corridors, and still preserve its strong unit economics. Because that 1% to 1.5% net margin, that's essentially its operating profit on the transaction itself.
They have room to maneuver on price.
They have significant room. They are structurally set up to absorb potential cost compression much better than traditional competitors who have higher fixed costs and rely on much larger gross margins. The stablecoin threat might actually become a cost advantage for them if it lowers wholesale FX costs.
That's a really interesting counter-narrative. Okay, final piece of the bear case puzzle.
Yeah.
Immigration and regulation. These were apparently cited as potential headwinds in that preliminary 2026 outlook that spooked everyone.
That's correct. Management's initial commentary for 2026 did include an acknowledgement of potential, quote, immigration headwinds, unquote, in some of their key send countries like the US and Canada.
Meaning potentially fewer new immigrants arriving.
Exactly. Or maybe slower growth in that population. And this spooked investors because logically it suggests a potential temporary slowdown in the inflow of new customers who are a core source of their volume growth historically.
Seen as a weakness, especially heading into Q4.
Especially heading into Q4, which is typically a seasonally strong period for remittances due to holidays. So the market interpreted that as a potential sign of near-term weakness.
Okay, so a potential short-term headwind on new customer growth. But isn't this momentary concern being completely overshadowed, or shouldn't it be, by a massive structural regulatory tailwind that's literally about to kick in next year?
You're talking about the one big beautiful bill, as some proponents call it. Yes, this is potentially huge.
Explain what it is. Okay.
Effective January 1st, 2026. So very soon, a new 1% federal tax will be imposed in the U.S. on all cash and other physical remittance instruments.
So sending money via a physical agent using cash.
Exactly, or money orders, things like that.
Right.
Now, here is the absolute critical kicker in that legislation.
What is it?
It explicitly exempts digitally funded transactions.
Wow, okay. So if you use Remitly's app funded from your bank account or debit card, no tax.
No tax.
Yeah,
But if you go to a traditional competitor like a Western Union or MoneyGram agent and pay with cash...
boom, 1% federal tax added on top.
Exactly. So think about what this does to the competitive landscape. For competitors who still rely heavily on cash-funded transfers, and that's a significant chunk of the legacy business, this is essentially a direct 1% tax imposed on their core business model.
That sounds financially crippling for them.
It's incredibly painful. Imagine a legacy player is already struggling with maybe a 5% or higher average take rate. They've got high operational costs from their physical network. Maybe their volume is already declining.
Yeah.
And now the government is adding a 1% federal tax burden that they either have to absorb, crushing their already thin margins, or they have to pass it on to the customer.
Making their already expensive service even less competitive.
Precisely. Meanwhile, for Remitly, which is 100% digitally funded and therefore completely exempt from this tax,
That's a massive advantage.
it massively amplifies their existing cost and efficiency advantage. It acts as a profound structural catalyst that should accelerate the long-term, irreversible shift from cash-based remittances to digital platforms like theirs. This tax advantage alone is potentially worth millions and millions in incremental volume and margin expansion over time.
Okay, that structural tailwind, the tax exemption, it gives us a perfect bridge back to the hard numbers. Because this is where the market's seemingly irrational fear really just collides head-on with the actual reality of the business performance.
Right. Let's look at the facts on the ground.
Let's run through those Q3 2025 performance highlights again.
Okay, the numbers, as we said, were spectacular by almost any measure. Revenue hit $419.5 million.
Which was up how much?
Up 25% year over year, solid growth. But send volume, the actual amount of money people moved through the platform, that accelerated even faster.
How much faster?
It hit $19.5 billion in the quarter. That was up a remarkable 35% year over year.
Wow, 35% growth in volume is huge at that scale.
It's massive. They truly crushed the top-line volume metric.
Okay, but we noted this discrepancy earlier. Send volume growing faster at 35% than revenue, which grew at 25%,
Yeah.
which mathematically means the take rate, the percentage they keep, compressed a bit. It landed at 2.15% in Q3. So the bear argument might be, is this a sign of dangerous margin erosion? Are they being forced to cut prices unsustainably? Or is it strategic?
Yeah, that's the key question, and management is absolutely crystal clear on this point. This is an intentional strategic investment,
Yeah.
not a sign of weakness.
Okay.
The declining take rate is a direct result of specific, targeted price promotions and investments they made. These were aimed at two primary segments.
Which are?
First, attracting more high-amount senders, getting people comfortable sending larger sums. And second, incentivizing first-time, high-potential customers to try the service and become repeat users.
So they're consciously sacrificing a small piece of the rate on some transactions.
Exactly. A small slice of rate in exchange for what they believe will be a massive expansion in overall customer lifetime value down the road. It's a long-term play.
And does the data we have confirm this strategy is actually working? Are they getting the volume and the valuable customers?
It absolutely confirms it's working beautifully so far. Look at active customers. That grew a strong 21% year over year, reaching nearly 8.9 million quarterly active users.
Almost 9 million people using it regularly.
Right. But crucially, look at the send volume per active customer. That increased 11% year over year, hitting $2,171 on average in Q3.
So existing customers are sending more money more often, or both.
Both. It shows their price investments are successfully enticing users not just to maybe send more frequently, but also to trust Remitly with larger average transaction sizes over time.
Any specific data on larger sends?
Yes. They specifically called out that volume coming from transactions over $1,000 grew more than 40% year over year in Q3.
40% growth in large transactions.
Huge. It clearly indicates they are successfully capturing deeper wallet share from their users, moving upmarket alongside their core smaller send business.
Okay, strong volume, strong customer growth, success in moving upmarket. Now let's get to what you called the most important metric, the one that, frankly, should have prevented any kind of panic sell-off.
Yes, the profitability milestone.
This feels like the moment the whole narrative should pivot.
It really should, because Remitly achieved positive GAAP net income. Real black and white profit according to standard accounting rules.
How much?
$8.8 million in Q3 2025. Now, that might not sound like a huge number compared to the revenue.
But the growth is key.
The growth is explosive. That $8.8 million is up 361% compared to the small GAAP loss they had in the same quarter last year.
361% increase from loss to profit.
Exactly. For a company that has historically been valued purely as a fast-growing but money-losing tech company, flipping to positive GAAP net income is not just a minor beat. It is the fundamental proof that the business model works efficiently at scale.
The model is validated.
It's validated, and management is now confident enough, based on this trajectory, to forecast positive GAAP net income for the full year 2025.
So the promise of future profitability has actually become reality now.
It's here. The inflection point has arrived.
And often when a growth company successfully makes that transition, from being valued purely on revenue multiples to potentially being valued on earnings multiples, that's often when the market completely re-rates the stock, right?
That's historically when you see major multiple expansion, yes. This profitability inflection really signals that that crucial shift should be underway for Remitly.
And do the adjusted metrics, like adjusted EBITDA, also support this picture of improving profitability and scale?
They absolutely do. They confirm the overall operating scale and leverage. Q3 adjusted EBITDA hit $61.2 million.
Which translates to what kind of margin?
A very healthy 15% adjusted EBITDA margin. And again, reflecting the strong performance, they significantly raised their full year 2025 adjusted EBITDA guidance. The new range is $234 million to $236 million.
So strong underlying profitability is growing fast.
Very fast.
Now, when we talk about operating leverage in a business like this, one that's based on transactions, analysts often track a specific metric quite closely. They sometimes call it the North Star metric for these kinds of companies.
You're probably talking about RLTE, dollar growth, revenue less transaction expense.
Exactly. Explain RLTE and why it's important.
Right. So you can think of transaction expense as basically Remitly's cost of goods sold. It's the direct costs associated with processing each transaction, bank fees, payout, partner fees, etc.
Okay.
RLTE is simply the revenue minus those direct transaction expenses. And that RLTE figure grew 23.4% year over year in Q3.
So growing slightly slower than revenue, but faster than.
Well, the key is that the dollar amount of RLTE is growing strongly. Why this metric is the North Star is because it reflects the inherent efficiency and scalability of their operating model as their revenue grows. The associated direct transaction costs tend to grow a bit slower, especially as they gain scale and negotiating power with partners, which means more and more of each incremental revenue dollar flows straight through to cover their fixed operating expenses, like R&D, marketing, G&A, and ultimately contributes to operating profit.
That's the definition of operating leverage.
That is the definition of operating leverage in practice. Seeing strong RLTE dollar growth proves their model is becoming fundamentally more capital efficient as they scale. The machine is working better and better.
And we keep coming back to efficiency. You mentioned that LTV to CAC ratio earlier, the customer acquisition machine. Still running smoothly despite the growth.
Remarkably smoothly. That 6x LTV to CAC ratio combined with the sub-12-month payback period on acquiring new customers.
Yeah.
It demonstrates they can still acquire customers very profitably, even while spending competitively on marketing in a noisy market.
They're not having to buy growth at unprofitable rates.
Not at all. They're effectively funding their own impressive growth through their retained earnings and the efficient monetization of their existing customer base. That's really the hallmark of a healthy, sustainable digital platform business.
Okay, before we move off the financials, I have to bring up that detail about the CEO's compensation. Because when you look at the signals of executive confidence here, it really speaks volumes, doesn't it?
It's genuinely astonishing and incredibly rare, especially in the hyper-compensated world of modern tech leadership.
What's the detail?
The co-founder and CEO, Matt Oppenheimer, he is reportedly the lowest paid named executive officer in the company.
Lowest paid.
Yes, taking a relatively modest cash salary, somewhere around $290,000 a year. But here's the kicker.
Yeah.
He has actively declined all equity awards, stock options, restricted stock units for the last 3 years running.
Wait, he turned down potentially millions of dollars in stock compensation for 3 years.
He did. Voluntarily declined it. And this is why it's so significant from an investor perspective. It signals extreme, almost unwavering long-term confidence in the future value of the equity he already owns as a co-founder. He's essentially saying, I don't need more stock right now. I believe the stock I have is going to be worth vastly more in the future.
Wow.
He's directly committing to minimizing shareholder dilution, which is often a major concern with high-growth tech companies paying out lots of stock. And he's telling the market through his own actions, not just words, that he believes the current stock price is dramatically undervalued.
That's about the strongest signal of alignment and long-term commitment you could possibly find from a founder CEO, isn't it?
It really is. Actions speak louder than words, especially when those actions involve turning down millions of dollars.
Okay, that level of founder confidence just makes that initial 2026 outlook conundrum, the deceleration fear that apparently caused the sell-off feel even more, well, maybe short-sighted or ridiculous in context.
It does feel that way when you stack it all up. The market reacted incredibly violently to the idea of growth potentially slowing from, say, 28% down to the high teens, maybe 17, 18, 19%.
Still very strong growth for most companies.
Absolutely. But investors like Mario Sabelli argue very persuasively that focusing solely on that top-line deceleration completely misses the potentially massive margin expansion opportunity that's unfolding simultaneously.
Because of that operating leverage and profitability inflection we just discussed?
Exactly. And remember, the traditional incumbents, the Western unions of the world, even with their high-cost physical networks, they still manage to maintain GAAP operating margins somewhere around 18% to 19%.
Okay, 18, 19% margins for the old guard.
Right. So the thinking goes, if Remitly, with its inherently more efficient digital model, its lower cost structure, its AI-driven operations,
Yeah.
if they can eventually achieve or maybe even exceed those kinds of incumbent operating margins,
Yeah.
the impact on their actual bottom line earnings, their net income, could be absolutely tectonic, even with slightly slower revenue growth than in the hypergrowth phase.
But the profit growth could far outpace the revenue growth.
Precisely. Even under what you might consider unspectacular long-term growth assumptions, let's say, just for argument's sake, revenue growth averages around 13.5% annually through the year 2030. Some modeling suggests Remitly could still be generating hundreds and hundreds of billions of dollars in GAAP net income by the end of the decade.
Hundreds of millions in profit.
Yes. So the shift here, the potential re-rating story, is profound. The focus moves from Remitly being just a hyper-growth company valued solely on its revenue to Remitly becoming a highly profitable digital-first financial institution that should be valued based on its significant long-term earnings power. And that typically justifies a much, much higher valuation multiple than the market is currently applying.
Okay, so the core business is hitting profitability, showing leverage. But to maintain an impressive growth trajectory long-term, especially as that core PDP remittance market inevitably matures somewhat, it really needs other growth levers, right?
Absolutely. They can't just rely on the original product forever. And they're actively pulling several strategic growth levers right now. They're expanding their product offerings, and critically, they're moving deliberately upmarket.
Leveraging the customer base they already have.
Exactly. They recognize they've built phenomenal trust with those nearly 8.9 million active users. And the plan is clearly to leverage that trust, that relationship, to capture a much larger share of those customers' overall financial lives, not just the remittance piece.
Okay, so first, let's look at that customer segment expansion you mentioned, specifically attracting higher value senders. How are they doing that?
Yeah, this is a very clear strategic push towards capturing larger average transaction volumes. One concrete step was raising the send limits for certain U.S. customers quite dramatically,
How high?
up to $100,000 per transfer in some cases.
Wow, from small essential sends to potentially 100K. That's a big shift.
It signals they're serious about handling more significant sums. And we saw the results starting to flow through in Q3. As we mentioned, that volume coming specifically from transactions over $1,000 grew over 40% year over year.
Huge growth in the bigger ticket sizes.
It really indicates they are successfully competing for and winning these larger, often more complex transfers, and those typically come with a higher absolute dollar profitability profile, even if the percentage take rate is slightly lower.
Makes sense. But the real game changer in terms of expanding their potential market size seems to be Remitly business, right? This feels like it fundamentally changes the scope of their total addressable market, or TAM.
Oh, this is the massive leverage point. Absolutely.
Okay.
You look at the traditional P2P consumer remittance market, people sending money home to family, that's estimated globally to be somewhere around $2 trillion a year in flow. Huge market.
2 trillion. Okay.
But when you expand the view to include cross-border payments for small and medium-sized businesses, think businesses paying international contractors, suppliers, remote employees, handling invoices across borders. Yeah.
That total addressable market expands tenfold. The estimates there are closer to $22 trillion annually.
Wow. From 2T to 22T, that's enormous.
Enormous. And Remitly Business is their dedicated product, their vehicle to attack that huge, largely untapped commercial opportunity.
So how's the traction looking for Remitly Business? It's relatively new, isn't it?
It is relatively new, but it's showing phenomenal early traction already. They launched initially just in the US, then quickly expanded to the UK and Canada.
Okay.
And they already serve nearly 10,000 active businesses on the platform.
10,000 businesses already.
Yep. And the key metric here, again, is the transaction size. The average transaction size for Remitly Business is nearly double the average size of their core consumer category transfers.
Double the size. And the volume.
The business send volume, the total amount moved by businesses, nearly doubled just sequentially from Q2 to Q3 2025. So rapid acceleration.
Wow. Doubling quarter over quarter. That's fast growth.
Very fast. Shows strong product market fit in the early days. And you found a great little anecdote that really demonstrates the specific type of user, the niche maybe, that this product is successfully capturing.
Yeah, the story of Derek Jefferson, who runs a small business called HTDB Comics based in the U.S., it's just perfect.
What does it do?
He uses 3 freelance consultants based in Nigeria for things like illustration work and storyboarding for his comics.
Okay, classic remote freelancer setup.
Exactly. And he uses Remitly Business because, in his words, the platform offers a customized, reliable, and really low-touch, easy experience for paying his remote team regularly. He'd already sent thousands of dollars across dozens of transactions just in 2025 using the platform.
So it's not just targeting like major corporations.
Not at all. It really illustrates that Remitly Business is meeting the high-frequency, essential, cross-border payment needs of micro and small businesses globally, the exact kind of segment that's often underserved by traditional banks.
Okay, interesting. So beyond moving into the business segment, they're also trying to deepen the relationship with their existing consumer base, right? Through what they call the ecosystem play. This includes things like the Remitly One membership.
Correct. The overarching goal here seems to be a strategic transition, moving from being seen as just a simple transactional provider, you use them once to send money, then maybe forget about them,
Yep.
to becoming a long-term financial relationship provider. Their internal vision talks about helping customers move, manage, and grow their money, much broader than just sending.
Okay, and Remitly One is part of that.
Remitly One is their $9.99 per month membership program. It's designed specifically to increase customer retention, loyalty, and engagement. They bundle premium benefits for members, things like flat fees on transfers, maybe enhanced customer support, exclusive offers.
Trying to make the relationship stickier.
Exactly. Build recurring revenue and deeper engagement.
Now, a key feature that seems to be part of that membership, or at least linked to it, is Remitly Flex. This one feels like maybe a higher risk venture for a remittance company. What is Flex?
Right. Remitly Flex is their send now, pay later offering, essentially a short-term credit product.
Buy now, pay later, but for remittances.
Pretty much. It directly addresses those liquidity mismatches that many of their customers face.
Yeah.
You know, needing to send money home urgently before their next paycheck actually arrives.
Okay. Sounds useful. Is it popular?
It seems to be gaining traction. They reported having over 100,000 active users on Remitly Flex by the end of Q3 2025.
100,000 users. But isn't lending to this particular customer base potentially very risky? Many of them might be considered credit invisible or have thin files in the traditional banking system.
That is the exact risk, yes, and it introduces significant potential credit risk, charge-offs, if not managed extremely carefully.
So how are they mitigating that risk? How are they underwriting these short-term loans?
This is where, again, their proprietary data moat becomes incredibly powerful. They are not relying on traditional FICO scores or external credit bureau data, which often doesn't capture their customers accurately.
What are they using instead?
They are leveraging the deep proprietary payment history data they have accumulated from their nearly 9 million active customers over many years. They know the frequency, the size, the destination, the consistency of every transaction a customer has made through their platform.
So they have their own internal credit score, essentially.
Effectively, yes. A highly predictive internal risk assessment based on actual remittance behavior. This rich data set allows them to offer small amounts of credit responsibly to customers they understand very well. And the results so far seem impressive.
How so?
Well, of the $20.8 million of outstanding Flex receivables at the end of Q3, nearly 90% were reported as current, meaning paid on time. And crucially, actual charge-offs, the money they've lost, have been essentially immaterial since the product launch.
Wow. So very low losses despite the perceived risk.
It demonstrates really superior operational control and underwriting capability over what is inherently a high-risk product segment. Their data advantage seems to be working here.
Okay. And Remitly One, the membership, is also integrating that global wallet capability we touched on earlier, right? Which circles back neatly to our stablecoin discussion.
Correct. The Remitly wallet isn't just a place to manage your Remitly account. It allows users to hold multi-currency balances. That includes both traditional fiat currencies and, significantly, stablecoins, starting with USDC.
So holding dollars digitally via USDC.
Exactly. And by enabling customers to hold these stable digital dollar balances, especially, as we discussed, in countries with volatile local currencies, they are positioning themselves to potentially disrupt traditional high-fee money changers.
Like the ones you see at airports.
Or local exchange bureaus. Why go there and pay high fees if you can hold stable dollars right within the Remitly app you already use and trust? It makes the app a much more powerful tool for managing money across borders, not just seeding it. A powerful retention and engagement driver.
Makes sense. Okay, finally, underpinning all of this, the efficiency, the risk management, the new products, we really have to acknowledge the role that artificial intelligence is playing in driving this massive scaling efficiency, don't we?
Oh, AI is absolutely the backbone of their cost reduction efforts and their ability to scale so efficiently. They're investing heavily in what they call Agentic AI.
Agentic AI, what does that do?
Think of it as AI agents capable of handling complex customer interactions. They reported that these AI systems handle nearly 2 million real-time customer support interactions in a recent period.
2 million interactions handled by AI.
Yes. And this technology has a dual benefit. First, it dramatically reduces the cost to serve each customer because you don't need a human agent for every single query or simple task.
Lowers overhead.
Significantly. But second, implemented well, it can actually increase customer satisfaction because issues get resolved instantly, 247, often contextually based on what the customer was doing in the app and without the customer having to wait in a queue for a human.
Instant automated help.
When it works well, yes. And they're finding clever new ways to embed that AI-driven experience right into the channels customers already use.
Like what?
Well, a recent example is their new integration allowing users to manage Remitly services directly within WhatsApp.
Sending money via WhatsApp chat.
Sending money, checking exchange rates, tracking transfer status, all seamlessly through a familiar conversational WhatsApp interface powered by their AI. This kind of AI-driven, highly personalized, channel-agnostic approach is absolutely crucial for scaling efficiently across diverse global markets, especially those where messaging apps like WhatsApp are the primary mode of digital communication. Hashtag tag tag outro.
Okay, so as we wrap up this really fascinating deep dive, we're kind of left with this enormous contradiction, aren't we?
It certainly feels that way.
On the one side, you've got this market narrative that seems completely dominated by short-term fears, the possibility of slowing immigration growth in North America next year, and this almost existential dread about stablecoin disruption wiping them out.
The fear narrative.
The fear narrative. But then, on the other side, you have the rock-solid concrete fundamentals that we've spent the last half hour detailing.
Right.
The GAAP profitability inflection point, they're actually making money now. That stunning 6x LTV to CAC ratio showing incredible customer acquisition efficiency. You've got that protective 1% tax exemption coming, a huge structural tailwind against cash competitors, and you've got clear evidence of successful, aggressive expansion into that massive $22 trillion business payments market.
Yeah, the contrast is stark. The company isn't just, talking about its long-term vision anymore. It is clearly executing flawlessly against it. It's transforming right now in real time from being just a promise of future growth into a demonstrably profitable, highly efficient digital financial platform, and maybe the best, most undeniable evidence of management's own confidence, right in the face of all this short-term narrative noise, is the action they took earlier in the year. The board approved a significant $200 million share buyback program back in Q2 2025.
Buying back their own stock.
Exactly. That is management using the company's own cash, shareholder cash, to make a direct, undeniable statement to the market. We believe our stock is fundamentally undervalued at these current prices. They're putting their money where their mouth is.
Right. Actions louder than words again. And that leads us perfectly into the final provocative thought we want to leave you, the listener, to explore on your own.
Okay.
The stock right now currently trades at valuation multiples that are often reserved for, shrinking, legacy, cash-based companies facing obsolescence, like the very companies Remitly is disrupting.
Yeah, it's valued like it's dying, not growing, and profitable.
Exactly. But Remitly, as we've shown, is demonstrating a clear trajectory as a digital category killer, built on over a decade of refined data, superior efficiency, and navigating complex regulatory moats. So the question is, if they continue scaling like this, if they continue proving that their digital-first model can achieve or even exceed those high operating margins, that 18% to 19% we talked about that the incumbents somehow manage, while simultaneously maintaining their demonstrably superior customer acquisition efficiency, how quickly will the market narrative have to fundamentally shift to catch up with those undeniable fundamentals?
When does reality force a re-rating?
Exactly. What is the true multiple? What's the fair valuation for a deeply profitable, rapidly growing, digital-first financial services provider that has successfully navigated that treacherous last-mile problem and is now effectively attacking a $22 trillion addressable market?
That's the multi-billion-dollar question, isn't it?
That is the opportunity or the puzzle in front of you today. Thank you so much for joining us for this essential deep dive into the complex world of Remitly Global.
Always a pleasure. Great discussion.